Welcome back to the channel. This week I will discuss my take on the holy trios of high finance: private equity, venture capital, and hedge fund. There is a long-term destination for most who pursue high finance. I will cover areas such as entry point, day-to-day on the job, progression path and compensation, pros and cons on the job, and finally, the grass is greener syndrome. Let's get into it. The holy trios are all investing roles, despite not having the name investing in their description. Their job is very simple. It's to make more money using clients' money. Of course, it's easier said than done, right? And with great responsibility comes great power. They're indeed the first-class citizen in the high finance world, with the highest compensation upside trajectory, and they're served by the very profession that you aspire to get into, which are investment banking, management consulting, equity research, etc. And with great power comes great responsibility. Now you really need to know what you're doing. These are no longer the days that you can mindlessly making a pitch deck in investment banking or writing an earnings note that nobody reads in sell-side equity research. Your work in hedge fund, venture capital, or private equity can mean millions, if not billions, of clients' capital being put to work. So once you're in the holy trio, this will be your first just got real moment. And the holy trio typically does not hire straight out of college because they know the investment bank and the consultancy will train the juniors on the foundational skills so that these firms don't need to train them. They rather focus on making more money. That's how the idea of exit opportunity came about in the first place, because there is no direct path from the undergraduate to the holy trio. There are exceptions, but most of us are not that wonderkin from Yale who got into Blackstone directly out of college. So you might want to keep watching. Please know everything I say is a generalization. These professions are very fragmented in terms of numbers of firms, and they all somewhat doing their own thing in their own way. So in the first part of this three-part series, I'm going to dive a little bit deeper into the profession of private equity. Private equity, they invest in private companies or turning a publicly traded company private. The idea behind it is really simple. Most of them do leverage buyout, which is a fancy technical term that really just means buying a whole business using mostly debt. It's just like buying a car or a house using a loan. Over time, as you pay down the loan, your ownership or equity in the car or house increases, thereby creating value for yourself. Of course, owning a business is a lot more complicated than that, but the overall concept is the same. The private equity investors are truly long-term investors. Not your typical private equity approach to public market hedge fund types who have a 500% annual portfolio turnovers. The PE investors actually do have a average 3 to 7 year holding period. They focus on operational improvements in the business to make sure there's enough cash flow to service the heavy debt load. And their diligence is very deep because you do have information as a private investor that the public market investor do not have access to. And you own 100% of the company, so you have discretion as to how to run the business going forward. With that said, you're not in control of external macro factors or how the industry and competitive dynamics change around you. So it is still far from a sure thing of making money in private equity. In terms of entry point, investment banking is the most typical feeder into the profession with the most relevant transferable skill set to be hit the ground running in private equity on day one. There is a path directly into private equity from the undergraduate level, but that's really reserved for the most elite colleges in the United States. I'm hypothesizing it's Ivy League. There's also management consulting, but the risk here is without the investment banking transactional experience, there is risk that you are perceived to be a more operational person than a financial person, and that you won't be able to get into a typical private equity associate path. Without investment banking experience, it's very difficult to break into private equity. So do not think just because you now have an MBA, you can get into private equity without doing investment banking. If you pursue an MBA, you will need to be an investment banking associate first. And there's no guarantee that the most elite private equity firms will be receptive to your background, as they typically hire from analysts who came out of undergraduate program. On a day-to-day basis, the juniors are involved in the following things: modeling, namely LBO modeling, research and diligence, writing investment memos, and support portfolio companies. Hours are 65 hours on average, but it can converge to investment banking hours when you are executing on a live transaction. The work-life balance in general in private equity is overall better than investment banking. But if you're comparing to insanity, anything is normal, right? In terms of the hierarchies, first you have the associates. They are the doers, modeling, writing, making presentations. You thought you were done with that after investment banking, right? And then there's vice president, VP. They transition from a doer to more of a project manager. And then you have the directors who are more removed from the deal process itself, increasingly focusing on deal sourcing. Finally, you have the partners. The partners are the ones who have paid their dues. They are more focused on sourcing private business for the private equity firm to buy by talking to the owners. And on the other hand, they are representing the firm during fundraising and industry conferences to build a brand for the firm so that they can have more money to deploy so that everybody makes more money. All right, let's get into the fun stuff, the money. I did some research and I'm never working private equity and probably will never work in private equity, but man, they make a lot of money, so sounds good to me. So the thing with private equity compensation is kind of similar to my experience with hedge fund compensation, which is it really depends on the size of the firm you work at. So based on my research, private equity compensation is pretty rigid and stable in a good way. To get your attention, I will use mega PE funds compensation as an example because they are the highest in absolute dollars, and that will be your Blackstone, KKR, and Carlyle. So 2021 average base plus bonus at different rankings. Analyst 350,000, VP 750,000, principal 1 million, partner 2 million. That doesn't even paint the picture at all for how lucrative private equity can be, because that's not where the action is actually at. For PE professional, carry interest is where the action is really at, which is a share of the private equity firm's performance fee, assuming a fund achieves a certain hurdle rate. And VPs and above ranking start getting carry interest, and the percentage increases as you increase in rank within the PE firm for being perceived to be a more valuable contributor to the firm. Carry interest can be volatile, but in a given year, a VP and above can get millions or even tens of millions of carry interest in a single year. So the good thing about private equity is with long duration capital, you get to conduct very deep research and you are long-term oriented. You also get to learn about the operations of different kinds of businesses, which lead to good exit opportunities because you cannot beat a good combination of financial and operation skill. I noticed some of the high impact, high profile corporate jobs pretty much require experience in either management consulting or private equity. And also private equity relatively has more job security than a hedge fund. The bad is it's still a very long hour. It's like you never left investment banking, and it takes a long time to progress to the senior level. As you see, there's quite few layers between the associate and the partner. And no matter what subgenre of private equity you choose to pursue, you will be looking at steady but not so sexy businesses. If that's what you like, that's okay. I do see a lot of private equity people want to move to hedge fund for the following reason. Like they don't want to deal with the process work in private equity, which is laborious and time consuming. They want to focus 100% of their time just identifying actionable stock ideas. They want better hours, and they want higher compensation upside and a faster progression to, say, senior analyst or portfolio manager, which is provided in a hedge fund environment. But I want to point out the trade-offs. Hedge fund is much less stable. The duration of capital is shorter. You have a tighter leash to perform. You can make zero bonus in a year. Even worse, your fund can blow up. You will be out of a job. This is very topical right now because I assume a lot of hedge funds are shutting down as we speak. Our is better, but no one becomes a good investor by putting in the bare minimum. Just be aware of that. You will never be truly off at a hedge fund. To me, hedge fund is just very long hour but condensed. Velocity goes up, stress is higher, equally driving burnouts like how long hour drives burnouts in private equity. And a critical factor in compensation upside in the holy trio is how quickly your total asset under management will grow. When was the last time you heard a hedge fund raising tens of billions of dollars? The hedge fund industry in the broader public investment management profession is flat at most and in reality secularly declining. As an investor, I personally like to invest where the tailwind is. And that's not what the hedge funds are facing going forward. Check out this video if you want to learn more about different types of public investment management styles, such as a hedge fund. If you found this helpful, please click like, subscribe, and hit the bell icon for future content updates. I'll talk to you next week. Peace.